Senator Menendez in New Jersey.
Thank you, Mr. Chairman. After announcing the rate hike pause last week, you said that inflation has not reacted much to the Fed's past hikes. And I'll admit I'm a bit puzzled by that statement. The Fed's first rate hike was in March of last year when non-core inflation was at 8.6%. It is now 4%, and core inflation has fallen as well. So that sounds like progress to me, especially when you consider that according to the San Francisco Federal Reserve, it can take more than a year for tax rate hikes to take full effect, which means that so far only 3 of the 10 rate hikes since last year are in full effect. So can you expand a bit more on that statement from last week? What progress do you expect to see that you currently aren't seeing?
Sure. So, of course, you're absolutely right. Headline inflation has come down by essentially half, but that's largely due to energy prices coming down and commodity prices that go into food coming down. And those are not, I won't say that they're not affected at all by monetary policy, but they're principally affected by other things in the economy. You know, the war in Ukraine drove energy prices up quite a bit, and also food prices. That's not really, those things are not principally a function of monetary policy, although we probably have some effect at the margin. So we look at core inflation, and we look, at how tight the economy is. We are seeing progress, for example, in supply chains getting better. That again is not really a function of monetary policy. Really, where monetary policy takes effect is in the service sector. And that's where we haven't seen much progress. So, but we are seeing progress in other places, as you point out. Inflation broadly is coming down, but as I said in my remarks, we still have a long way to go. Inflation is still running between 4% and 5%.
So do you think that the lag period for rate hikes to affect inflation has lengthened, or are rate hikes as a monetary policy tool becoming less effective?
I don't think they're becoming less effective, but these are real questions. And the thing with lags is, this day and age, financial conditions react before we act. So the markets are already pricing in rate hikes. So that's quicker. But the effect of those financial conditions on the economy still takes time. It works very quickly on housing, for example, but less so on the service sector, which is not very interest sensitive. So I don't think that has changed. Others have a different view and different directions they think in which it's changed. There's not a consensus agreement on how long monetary policy takes to affect the economy. So some people think a very long time, some people think right away. So I tend to think let's look at the middle of that, and a year and change is that's not a bad way to look at it. But policy actually started tightening well before that. Before we didn't raise rates until March, but policy had already tightened substantially before the first rate hike in March.
Well, I will say, I know that you have a dual mandate, you know that as well. The last jobs report shows that unemployment is starting to tick upward for women and African Americans. So I hope that the cure is not more consequential than what we're trying to achieve. Recent reports reported that there's almost $1.5 trillion in commercial mortgages that will come due in the next 2 years, many of them held by small and regional lenders. With property values declining and interest rates rising, these mortgages could be serious liabilities for many banks. Do you think that we may see some banks fail as these mortgages come due? And if so, what can we do ahead of time to prevent that scenario?
So we're spending a lot of time on these issues, and we have been for quite some time. And again, I think you put your finger on it. It's really which banks have concentrations, high concentrations of real estate, and that is not seen in the large banks. It's seen in some of the smaller banks. So we've identified those banks, and there's a supervisory toolkit where we work with banks to try to help them resolve those issues by raising capital or dealing with what's happening. And of course, what is happening in the office space nationally? There's an issue with people working from home and just less demand. There's a sort of one-time adjustment going on. There are also some other pockets of commercial real estate where there's some softness. So we're working with banks to work our way through this. We're very aware and very focused on the problem.
Well, I'm concerned that it's a ticking time bomb. And let me just say that last week you said that commercial real estate risks are unlikely to pose a systemic risk because the loans are broadly spread and mostly held by smaller banks. But how can we ensure that the potential losses in the commercial real estate don't lead to the draining of assets from smaller and mid-sized banks, and then create further consolidation in the banking sector that brings us back to, I don't want to be back to 2008 when I was here and was asked to do extraordinary things.
We certainly don't want to be there either. And so we're being pretty proactive about reaching out to these institutions and trying to help them get through these significant issues. Again, it's not all smaller banks. It's just some of them have high concentrations in real estate, and it's not in the large banks, which of course was where the problem was in 2008 and 9.
Thank you, Mr. Chairman.
Thanks, Senator. Senator Kennedy of Louisiana is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you for being here, Mr. Chairman.